Hello and welcome to our first presentation in MBA 230, Advanced Financial Management. In this presentation we, Michael Freitz and I, Niels Rieckhoff, would like to talk about the financial analysis of two publicly traded firms, Western Digital Corporation and Seagate Technology. Areas we'd like to address today include the structure of ownership, the cost of debt, the cost of equity and the weighted average cost of capital, as well as a possible restructuring in terms of capital structure and the valuation of these two companies. The first question we'd like to discuss is, who are our shareholders? Let's have a look at Western Digital first. The company has around 237 million shares outstanding, from which 83.12% are owned by institutional investors, leaving only 16.82% for private investors and others. The top 10 institutions amongst the shareholders of Western Digital hold 24.82%. The main shareholders of Western Digital are mostly huge investing companies and funds. Comparing all this with Seagate, which has 357.06 million shares outstanding and is owned by institutional investors by 78.29%, it is remarkable that there are some companies among the main shareholders of both companies, such as Vanguard Group, Fidelity, State Street, BlackRock, and others.
So, do our shareholders care about our cost of capital? Well, they should, because companies use their cost of capital as a baseline to determine what investments and projects to pursue. If the expected return of a project is greater than the cost of capital, then they should be expecting to make money off it, all else remaining equal. And the reverse also holds true. If the cost runs greater than WACC, then the firm should expect to lose money on the project, though they may go forward with it anyway for other reasons. Stakeholders should care more about just the overall cost of capital, but also the breakdown between the debt and equity portions. As shown above, debt has the added benefit of reducing a company's tax burden, while equity has no such bonus. Also, as a whole, debt tends to be cheaper than equity, so companies can load up on cheap debt to significantly drop their weighted average cost of capital. Naturally, there are some good reasons that they don't. Shareholders aren't overly enthusiastic about companies being over-leveraged, since it directly affects their returns. Interest is going to have to be paid on any debt a company takes on, which comes directly out of earnings that could otherwise be returned to the investors. However, they also want the company to make enough money so that some of those earnings get returned to them. Bankruptcy is going to be a concern when companies wind up over-leveraged. In the event of a liquidation, bondholders have a higher claim on remaining funds, while stockholders are pretty near the bottom of the list when distributing whatever's left over. Now, at the same time, cost of capital has a direct impact on a company's value. The lower the cost of capital, the higher the value, as shown with modeled cash flows shown above. So if the company can reduce the weighted average cost of capital as low as possible while maintaining high cash flows, the value is going to be maximized, which is naturally good for all involved.
After looking at the shareholders and why they are interested into the cost of capital of a company, now we'd like to have a closer look at the actual cost of capital. Therefore, we start with the question, what is our cost of debt financing? First of all, let's have a look on the components of the cost of debt. One part of the cost of debt is the risk-free rate, which every borrower has to pay. The risk-free rate has to be paid as a compensation for the lender, who gives the money to the borrower for a specific time. The second part of the cost of debt is the default spread. This spread has to be paid because of the default risk. The spread depends on how stable the borrower is. That means how good his financial standing is. This standing can, for example, be expressed in a credit rating from rating companies such as Standard & Poor's, Moody's or Fitch. On this slide you see the relation between the S&P rating and the default spread, which has to be added to the risk-free rate to get the cost of debt. Unfortunately, it was no rating for Western Digital available, what made it kind of difficult to get the right default spread. To find out what the rating should look like, we used the capital structure spreadsheet of Professor Damodaran from the New York University. This spreadsheet gives us, after putting in several financial data, a rating just like a rating of Standard & Poor's. Therefore, we were able to get a default spread for Western Digital, which is 0.4%. Seagate's outstanding bonds currently have a rating of BB+, which gives us a default spread of 3%. As there is no real risk-free rate, we have to assume that the interest rate of a bond, which is considered as risk-free, is equal to the risk-free rate. Therefore, we used the interest rate of the 10-year US Treasury bonds as of June 28th, which is 2.52%. Adding the spreads up with the risk-free rate, we get the cost of debt before taxes. The pre-tax cost of debt for Western Digital are 3.37%. For Seagate, it is 5.52%. As interest rates of debt are tax deductible, we can calculate cost of debt before and after tax. To calculate the cost of debt after tax, we multiplied the pre-tax cost of debt with 1 minus tax rate. The tax rates we used here are the 5-year historic tax rates to get a good average over the past years. Calculating the cost of debt after tax gives us 3.03% for Western Digital and 5.38% for Seagate.
Cost of equity is found using the capital asset pricing model, which determines an equity's expected returns. As shown below with the equation for the security market line, the return on a stock is a function of 3 factors: the risk-free rate, the stock's beta, and the market risk premium. The risk-free rate we used was the 10-year return on T-bonds as of June 28, 2013, which was 2.52%. The market risk premium was taken from historical averages calculated by Dr. Damateran and found to be 5.78%. While these two numbers were relatively easy to get, the betas took a little bit more work to find. Beta reflects how volatile a stock is relative to the market as a whole. For the market, we used the S&P 500, and for both we took the monthly returns over the last 5 years and compared them, and then we plugged them into a regression model and found the assumed betas for Western Digital and Seagate. Western Digital came up with a beta of 1.41, while Seagate came up with a much higher beta of 2.41. So, we can assume that both are more volatile than the market, while Seagate is significantly more so. So, as a way to make sure that we weren't completely off the mark, we compared the betas that we found to those by several major websites. Now, naturally, since each one uses a different set of assumptions, the values aren't going to be uniform. However, in both cases, they were reasonably close. Now, the one outlier was from Yahoo for Seagate, which had a beta of 2.96 compared to the 2.4s that showed up for everyone else. So naturally, we can assume that these aren't going to be perfect, but they seem reasonably accurate. Now that we have all of our inputs, it's just a matter of plugging them into the equation to get the cost of equity. Again, taking the risk-free rate of 2.52%, the market risk premium of 5.78%, and the betas, we wind up with a cost of equity of 10.67% for Western Digital and 16.45% for Seagate. Now, as far as which one's better, well, cheaper cost of capital is preferable, so Western Digital has the superior option.
To find the overall cost of capital, we use the formula for the weighted average cost of capital. The weighted average cost of capital are influenced by the proportion of equity times the cost of equity and the proportion of debt times the cost of debt times 1 minus the tax rate. By plugging in all the numbers for Western Digital, we get the overall cost of capital of 9.75%. Compared to Western Digital, Seagate's cost of capital are a lot higher, with 14.64%.
After taking all this information, we modeled the companies at a series of different leverage ratios to determine the optimal capital structure. As it turns out, both could benefit by taking on additional debt. It would increase their company's value and lower their cost of capital. Western Digital had an optimal ratio of 30% debt to equity, which would increase their cost of equity by 1.32%, their debt by 0.36%, but cut their weighted average cost of capital by 0.58%. Seagate's optimal structure was found to be about 50% debt to equity. This would cause a jump in their cost of equity by almost 6%, but their weighted average cost of capital would be cut by 1.79%. Now, there were a few issues with this model, and the biggest one was that of taxes. Both companies pay well below the assumed rate of 40%, which causes the model to overestimate the benefit of debt. Now, while both companies can be assumed to take advantage of every possible tax benefit, they likely reduce the tax burden that we had assumed in prior calculations. And since the model was relying on interest coverage ratios to provide the credit ratings, they probably produced overly optimistic estimates of what the credit ratings would be under the optimal scenarios. With those considerations in mind, we determined that Western Digital has the more realistic scenario. Because if you look at Seagate, their cost of debt, both optimally and current, is lower than their current one. And they're assuming that the company would maintain a higher credit rating even though they would be taking on significantly more debt. Now also, Seagate's taxes are already so low that they begin to reach a point of diminishing returns on debt financing, so their average cost of capital is likely to be significantly higher than the model assumes.
If both companies would follow the proposed restructuring, the companies would experience a significant increase in value. Western Digital's value would increase from 16.71 billion by 1.476 billion to 18.187 billion. Seagate's value would change by 3.5 billion from 19.126 to 22.627 billion. Seagate's value increases even more because of the higher reduction in the cost of capital. However, the likeliness of such a change might not be without any doubt, as the increase in leverage would be very large and might not be as good for the opportunity of analysts and investors, resulting in higher expected default risk premiums.
Would more debt create unnecessary risk? Well, it would certainly create more risk, since it would increase the company's fixed costs in the form of higher interest payments, and it would cut down their flexibility. Now, flexibility is really important for technology companies, since they may need to adjust to market conditions by increasing expenditures on R&D, or take on additional leverage to finance an acquisition. Western Digital just spent $342 million on an acquisition this year. And also, there's the ever-present risk of default with more debt. Now, whether or not it's unnecessary would be a managerial decision. However, it's almost certainly an unnecessary risk for Seagate. Their credit rating is already barely investment grade, and the credit rating agencies have highlighted taking on additional leverage as motivation to cut their credit rating. And dropping their rating below investment grade could have negative impacts on their bondholders.
After having analyzed and compared Western Digital and Seagate, let's have a look on how they compare to the industry average and SanDisk, another company out of their industry. If we have a look on the debt to equity ratio, this time calculated with book values, Seagate is significantly higher leverage than the other companies. It has a debt to equity ratio of around 79% compared to the industry average of around 25%. Looking on the return on equity, we see what's the effect of Seagate's high leverage. It enables Seagate to provide a higher return on equity.
Now finally, we wanted to know whether our stock price was fairly valued. So we took a few different models and put in our data and saw what we came out with. Now, using the multipliers we acquired from comparing them to SanDisk, we found that Western Digital and Seagate were massively undervalued. However, this could be due to the fact that situations are significantly different between companies, so the fundamentals that determine the valuation of SanDisk wouldn't necessarily apply to Western Digital and Seagate. However, for the free cash flow model, we found that the values were relatively close, but that Western Digital was slightly overvalued and Seagate was slightly undervalued. Therefore, as someone purchasing stock, we would want to consider Seagate the preferable alternative, since it should be higher than it actually is.